My name is Dr. Clint Bourne. This presentation explains concepts and terms that deal with group health insurance, particularly for school districts. Upon conclusion of this presentation, you will be able to explain a school district's group medical insurance program, including health, dental, and vision insurances. Distinguish the differences between group medical insurance organizational formats, such as fully funded and self-funded. Compare and contrast the various delivery plan types: PPOs, HMOs, EPOs, indemnity, and high deductible plans. Examine prescription drug, dental, and vision plans, and understand related terms. Although specific medical benefit plans offered to school district employees vary by plan sponsors, such as states, districts, or consortiums, group health plans typically provide a full range of medical providers, hospitals, and prescription drug coverages. Ancillary benefits may include dental and vision insurance. The plan sponsor denotes the entity that establishes a group health or medical plan for its employees and eligible members, sets the plan design, educates members about services, and may hold fiduciary responsibility for the health plan. The health sponsor may be a school district, state, or organization like a consortium. The health insurance premium represents either the employer or employee's health benefit payment. When managing a group medical insurance program, the plan sponsor personnel must decide the program's administrative structure by choosing either a self-insured or a fully insured arrangement, with each having pros and cons. Districts in a traditional fully insured program contract with an insurance carrier and compensate the insurer in advance to cover the provider's projected claims, carrier's operating expenses, and administrative costs. The insurance carrier's designated employees process the district's claims. The fully insured plan ordinarily is more expensive than a self-insured plan, although the annual premium remains set in advance for a fully insured plan. The insurance company typically establishes a rate that greatly exceeds anticipated claims and expenses. Employees in this type of plan usually possess few incentives to lower cost services. Self-insurance refers to a risk management technique where a district or state assigns a pool of money in the budget to satisfy unexpected losses. When an actual claim expenses become payable in a self-insured plan, the state, district, or consortium insurance trust fund account generally offsets the insurance expenses. Self-insured states and school districts assume direct financial responsibility for all the expenses from covered members' claims. When the collected funds do not exceed the charges in self-insured plans, the outstanding insurance trust account balance remains in reserve or saved for future health insurance claims. When the charges exceed the collected premiums, the debt carries to the next month. Districts may elect to hedge actual claims with stop-loss insurance. By selecting a self-insured option as opposed to a fully funded method, the employer pays actual claims instead of the insurance carrier's premium. With self-funding, the employer assumes the entire financial risk except when using a stop-loss carrier. With full funding, the insurance company assumes the financial risk. In a self-funded structure, the employees have control of the plan design, including whether to use third-party administration or not. In full funding, the employer may be limited to the insurer's choice of benefits. Because the employer assumes full liability and risk for all claims with self-funding, uncertain monthly expenses and the uncontrollable timing of claims are budgeting challenges. However, when claims do not exceed the set-aside, the district keeps the actual savings. With this in mind, insurance self-insurance plans increased across the country. According to the Employer Health Benefits Survey of the Kaiser Family Foundation, 61% of all employer health plans in the United States are self-insured, while only 39% are fully funded. In order to mitigate a district's risk in a self-insured plan, the plan sponsor often utilizes a stop-loss carrier that reimburses the district for medical and/or pharmaceutical claims exceeding a predetermined threshold. The legal authority to regulate stop-loss insurance varies widely from state to state. Some states do not impose any regulations on stop-loss insurance, while other states enforce strict standards for stop-loss insurance. A stop-loss insurance policy typically covers two areas: an individual stop-loss amount and an aggregate stop-loss sum. Individual stop-loss coverage protects the district when a covered member has a single catastrophic claim or a series of claims that reach a particular cost point. Aggregate stop-loss coverage guards the district against collective individual claims above a set threshold and/or cumulative claims reaching a distinct point. Plan sponsors, in many instances, contract with a third-party administrator, or TPA, who is neither the policyholder nor the insurer. Although the third-party administrator does not assume any financial liability within the plan, this support organization exclusively administers the plan, disperses payments to providers from the district's account, credits the claim reserve when available, generates and shares utilization reports, negotiates provider fees, and processes claims in accordance with the insurance plan document. Single and family coverages are two other important distinctions that apply to fully insured and self-insured plans. Single coverage extends benefits only to the covered employee. Family coverage offers benefits to the covered employee and qualified benefits. According to the Employer Health Benefits Survey of the Kaiser Family Foundation, family health plans averaged $20,578 per year, and single health plans averaged $7,188. What type of health insurance structure does your plan sponsor or school district maintain? After considering the program format, plan sponsor decision makers may deliberate on the insurance delivery design, preferred provider organization, health maintenance organization, point of service, exclusive provider organization, consumer-directed health plan, or traditional indemnity. Due to the increasing cost of health care, managed care health plans such as HMOs, PPOs, EOSs, and EPOs remain popular choices to reduce the plan sponsor and enrollees' medical insurance expenses. Plan sponsor personnel in a managed care plan contract with healthcare providers and medical facilities to perform health services at an agreed-upon discounted fee. The managed care plan structure encourages insured participants to receive medical care from a network of pre-approved providers, even though enrollees may utilize services from providers outside the network at an extra cost. Plan sponsor personnel in a PPO, the most popular managed care design, contract with a group of healthcare providers within a network. In-network providers supply services at a discounted fee in exchange for the possibility of increased business. Participants may also receive health care from out-of-network providers without a major financial penalty. In an HMO, the insurer must stay in-network. The plan sponsor assigns a primary care physician who refers participants to in-network specialists and other healthcare professionals when necessary. When participants need medical services, they pay a nominal fee for in-network provider services. When an enrollee receives services from an out-of-network provider in an HMO, the participant's out-of-pocket cost may be more expensive than in-network provider services, or the service may not be covered. Although HMOs generally save money for participants and districts, covered members have a limited number of healthcare providers from which to obtain services than in a PPO. HMOs theoretically reduce district plan expenses by controlling specialist referrals and managing costs from in-network providers. In a PPO, the insured party has a greater choice of healthcare providers because PPOs are generally less restrictive than HMOs. Participants do not have a primary care provider but must get a referral to see a specialist. The insured shoulders a higher share of the medical expense from an out-of-network provider than an in-network provider. A POS design, a PPO HMO hybrid, is yet another managed care plan design. Plan sponsor staff members in a POS contract with a number of healthcare providers in networks like a PPO or HMO. Eligible enrollees, however, choose between in-network or out-of-network providers at the point of service. This plan type becomes attractive to participants who want the benefits of a managed care plan, but do not want to be restricted by only receiving medical care from in-network providers. In-network providers in a POS plan normally charge a discounted fee. Out-of-network service providers generally invoice by the usual, customary, and reasonable UCR rate. The UCR rate designates the fees that healthcare providers typically charge for a given service in a geographical area. Out-of-network providers, therefore, do not assume the HMO fee structure restrictions based on a fixed, predetermined monthly payment, regardless of provider care and the number of patient visits. In an EPO plan, an infrequently employed managed care design, health or medical insurance participants may only use in-network primary care providers, hospitals, or specialists. When an eligible enrollee utilizes an out-of-network provider, the EPO plan does not cover any out-of-network expenses except for emergency care, urgent care outside of the service area, or critical medical services that are not in a in-network provider's area. Consumer-directed health plans have recently gained popularity after approval by federal and state legislations. CDHPs in a high deductible health plan entrust enrollees to make decisions about their own health care. HDHPs generally offer lower premium costs than other managed care plans by encouraging participants to utilize lower cost providers. In CDHPs, the insured have greater flexibility with providers than an HMO. The health savings account structure enables enrollees to set aside money up to the IRS's pre-tax limit to pay for out-of-pocket expenses, including deductibles, co-pays, co-insurance, prescription medications, vision expenses, and dental costs. An employer may elect to contribute financially to an employee's health savings account. However, employees own their account and may add or withdraw dollars from the account at any time. However, in CDHPs, enrollees contribute a greater share of healthcare expense via a higher deductible than other plan types, and most expenses are completely out of pocket until the deductible is met. Traditional indemnity insurance plans became increasingly expensive in the late 20th century. The plan sponsor or employer contracts with an insurance carrier who sets the premiums to pay for annual health charges and often determines the health plan design. Under an indemnity structure, commonly called a fee-for-service plan, An insured member is not required to choose a primary health care provider, hospital, or pharmacy. When patients use health care services, they pay a deductible and copay to the provider, and the insurance company pays the provider for services. Due to the rising cost, this plan type decreased in popularity. With a wide latitude of design choices, many firms across the country offer members only one plan type, although a few districts may offer participants a choice of plan types. Considering all choices, 49% of all plan sponsors nationwide granted medical insurance through a PPO. 29% offered consumer-directed plans. 16% supplied HMOs, and 6% delivered POSs. Indemnity programs and EPOs were less than 1%. Because plan sponsors offer more than one delivery type, the sum of these percentages may not equal 100%. What type of insurance delivery design does your system offer? The plan document or benefit summary describes the plan sponsor and eligible employees' rights and responsibilities, medical care coverages, deductibles, co-pays, co-insurance, exclusions, limitations, annual benefit maximums, and the procedures to access benefits. What benefits, deductibles, co-pays, and co-insurance does your health insurance plan offer? The plan sponsor staff may purchase and grant prescription drug benefits with enrollment in a group health insurance plan or in a separate policy. A majority of prescription drug benefits, which are self-funded or fully insured plans, are associated with group health plans. Three kinds of prescription drug plans remain available to districts: reimbursement, prescription card, and mail order prescription drug programs. Similar to health indemnity plans, reimbursement plans pay benefits after an employee meets an annual deductible. Reimbursement plans normally remain the most expensive because pharmacies charge full retail price. A prescription card program functions like managed care health plans by offering prepaid benefits with nominal co-pays. A mail order prescription drug program dispenses medications for chronic medical conditions such as high blood pressure or high cholesterol. Mail order programs typically operate in combination with prescription drug cards. Prescription card and mail order programs are usually less expensive than reimbursement plans because plan sponsors, third-party administrators, or insurance companies have negotiated lower prices in exchange for the possibility of higher prescription drug volume. Dental insurance insures a portion of the costs associated with preventative care and treatment of dental conditions. The plan sponsor may purchase and grant dental benefits with enrollment in a group health insurance plan or in a separate policy. Similar to group medical insurance, the plan sponsor may finance group health insurance via self-insured or fully insured plans. Dental health benefits have three basic design structures: service corporation, maintenance organization, and traditional indemnity plans. Service corporations are state-owned and state-administered dental association nonprofit organizations. Participants in a service corporation type of plan may receive benefits for covered services from an in-network or out-of-network dental care provider. Service corporation plans, however, penalize enrollees by granting a smaller benefit for using an out-of-network provider instead of an in-network provider. Enrollees in a dental HMO receive services from a primary dental care provider. The in-network dental care provider may refer the insured party for services outside the network. Indemnity dental insurance is a type of fee-for-service plan that lets you see any dentist you choose. However, your insurance company only pays for care after you submit a claim. This means that you have to pay for the cost of care up front and then send your claim to your insurer for reimbursement. Dental insurance plans offer coverage for the following services: routine, preventative, and diagnostic care, which include oral examinations, cleanings and x-rays, fluoride treatments, and sealants, and non-routine care for fillings, periodontal treatments, extractions, oral surgery, bridges, crowns, and orthodontics. Vision insurance underwrites costs associated with eye care and eyewear. Similar to dental insurance, the plan sponsor staff may purchase and grant vision benefits with enrollment in a group health insurance plan or separate policy that may be fully funded or self-funded. Many employers offer vision insurance as a cafeteria plan with a benefits menu where the plan sponsor gives employees several plan options, such as an HMO or PPO that functions similarly to group health insurance. HMOs remain the most restrictive plan for examinations, with specified lenses and frames as the most common option. When an eye care provider in an HMO delivers a covered member's lens or frames outside the allowance, then the enrollee bears the extra cost. PPOs, on the other hand, steer employees to a network of participating eye care providers who have agreed to provide services for a negotiated rate. A vision plan often restricts the enrollee's number of eye care provider visits, such as 12 or 24 months in a year, or utilize a covered category. The schedule of benefits is easy for employees to understand because the plan normally states usage, frequency, and monetary caps, which are maximum allowances related to eye care and maintenance, such as routine eye examinations and testing, corrective eyewear for lenses and frames, and eye surgery. Do you have group dental or vision insurance sponsored by your district? What are the benefits in each? If you want to contain insurance costs, tune into the Advanced Group Health Insurance video or purchase the text Reduce School Expenses, Containing Insurance Costs, Funding Capital, and Tackling the Challenges on the Roman and Littlefield site. This concludes the Group Health Insurance 101 presentation. Feel free to leave comments